With the mortgage calculator. Today we're going to go through some live mortgage rates and then we're going to do a deep dive into ARMs. I don't think we've brought this topic up in quite a while, so this will be a good training here. Just wait a couple of moments to get started. We're going live on all the different platforms because we do stream this on Facebook, LinkedIn, and YouTube, as well as Spotify and Apple Music. Thank you, everybody, for tuning in on the podcast platforms as well. We'll get started here in just a moment. We did put the chat up on the screen, so feel free to drop a comment there as you tune in. Appreciate the comments there. Victoria, Warren, Jake, Owen, Nicole, thank you for the comments. Thank you for tuning in nice and early. Melvin as well. Happy Friday, everyone. All right, Christina, appreciate the comment there. All right, looks like we are live on all the different platforms, so we can go ahead and get started. As you tune in, feel free to keep dropping comments there in the chat and also drop any questions you have as we go through the presentation. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning on this show is go through the live mortgage rates for a few different programs. And then we do a deep dive into a different loan topic every day. Today's topic is going to be adjustable rate mortgages, or ARMs. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to do a deep dive into ARMs. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and go through the live mortgage rates. So Nick, if you're ready, let's pull up the pricing tool and see what the market is looking like this morning.
All right, switch my screen and we'll check it out. So this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR for our general programs. It is October 20th, just after 11 a.m. And the markets just went haywire. So today is probably going to be pretty nuts on the rates. If you'd like a full breakdown of all the different fees that go into the APR, please get with our team members. We have over 400 licensed loan officers, and we can do loans in 24 states for primary homes and 44 states for our business purpose. So for today's demo, as we do every day, we'll set up a standard scenario to compare across the programs. 400,000 loan amount is what we'll use for the demos. We'll set the LTV to 80% loan, 20% down payment. Especially because the rates are going crazy, we're going to look for the lowest possible rate. We're going to check out conforming first. Then we'll go into FHA, and then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional options. We also have VA and USDA. VA is only for vets and active service members that have eligibility. If you do have that eligibility, let us know. And same with USDA, that's only for properties that are eligible. So if you do happen to be looking at one of those, just let us know. We can quote it, no problem. Start with conforming conventional. We'll do a purchase, 30-year fixed, standard loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. For all the demos, we use an estimated credit score of 760 and an estimated debt-to-income ratio of 40. So with these basic settings, let's see what's going on. Oh, that's a little bit interesting here. So these options aren't realistic, so these don't really work. A little too expensive, so those need to be updated. So let's focus on the options that will work. So as usual, at the moment, we have our portfolio option, which is uses standard conventional guidelines, but isn't a actual Fannie Mae or Freddie Mac loan, as you see here. So the first option here is a portfolio. It's not technically conventional, but it's basically the same. 7.375 rate, 2.5 discount points and costs. Final APR 7.592. And then we'll see our first actual true conventional program here, 7.499 rate, 2.375 discount points. That's a final APR at 7.712. So just as expected, the treasuries are at I think, an 18-year high this morning, which means our APR is moving up here on the conventional loans here for the standard programs, which makes our portfolio option even more viable. So definitely recommend anybody out there checking out the conventional programs. Portfolio might be the way to go. Now let me go back to our pricer here. For any reason our customer doesn't qualify for conventional, which is usually the first option, we'll always want to look at an FHA program. FHA does allow more leniency on credit issues, as well as a much higher debt to income ratio we can use. However, we will keep everything exactly the same, so we can compare apples to apples across the program and compare the APR. So let's check out the FHA options this morning. And these went up a little bit as well, just because the markets have gone up. So 6.875, 2.25 discount points and costs, but the final APR 7.510. So right about the same as the portfolio option there. So they're about equal there. But if you're looking at a true conventional option, FHA is actually a little bit cheaper, as it has been recently for the last, ever since this year started, actually, pretty much. So definitely recommend our customers that qualify for both. Definitely don't overlook FHA. And for those that must use FHA for the leniency, definitely welcome changes, because this APR does include all of the mortgage insurance that they did change this year, which is great. Now, where we love to specialize is if our customer, unfortunately, doesn't qualify for either program. Many other banks or lenders will simply have to deny that customer. But that's where we love to go into our expanded guidelines, also known as non-QM, where we have over 5,000 other options beyond the standard options. So everything else will stay the same. However, now we can select a new income, which is what we use for non-QM. Full doc is what we use for conventional and FHA. So that's 2 years of tax returns. We would typically choose non-QM to take advantage of one of these alternates, like our asset related, business bank statement. The investor programs are just for investment properties. Personal bank statement 12 month is the one we use for the demo. We also have RSU, stated income, VOE, 1099, P&L, no income, CDFI, all kinds of different options. But the most popular here is the 12-month personal bank statement. And that's for our self-employed borrowers. Many times when our self-employed borrowers submit 2 years of tax returns, may have issues qualifying at all, or just may not quite get the income they need. Therefore, we'll solve either problem using no tax returns at all, just their last 12 bank statements, to determine a debt to income ratio of 40% in this example here, using no tax returns at all, just their cash in the bank. So most self-employed borrowers will qualify for double or more income using this method, and can therefore get that home they really want. So let's check out the non-QM solutions today. Man, with the rates going crazy, it's a little bit misleading. So sorry about the first options popping up. And even this second option is out of range of compliance. So let's focus in on the realistic options here. So portfolio, this is again the similar portfolio product. So it's a little bit unique version of the bank statement. 7.75 rate, 2.5 discount points and costs, 7.867 APR. And then we have our more standard bank statement option here, 7.99, 2.5 discount points of cost, 8.1 APR. So the APR here today, just a touch above conventional. And we have a few options that actually beat conventional, but it's just a little too expensive here. So tons of different options. When these rates are going crazy, the show isn't as easy to do because we get all these alternatives popping up. But all of these are great options. Please get with our team. And if we scroll down here, you see there's dozens, if not hundreds of different versions of bank statements. Some of these at higher rates and costs may allow bankruptcies, foreclosures, other issues, credit events, and may also allow slightly different variations in how they calculate the income. So tons of different options here. Please get with our team to find the best one, especially as the markets are going crazy. And now for our final demos here, we want to do some investment properties. So we'll set up the same scenario, ADLTV. And investment properties, we can buy down a little bit more. So we'll see the absolute lowest rate options to buy down here for conforming conventional and our expanded guidelines, also known as non-QM. Government programs like FHA, VA, and USDA do not work for investments. So we'll start here with conforming conventional. Everything will stay the same as our other demos. We've only edited the occupancy here. So let's see what the conventional programs have added for investments. Oh my goodness. So this is a little misleading again because the rates are going crazy. So this option is feasible. So this would be a good option. Again, this is the portfolio option with no loan level price adjustments. This is looking like 7.25 today for 3.5 discount points of cost. Puts the final APR at 7.5. Now, these options are the conventional options you see with the rates going crazy. These are absolutely insane. We could not legally offer a loan at 7 discount points. So I hate to say it here, but it's a little misleading. Let's scroll down to the actual realistic option, which here we go. This will be a realistic option. So the first real option here is going to be 7.99 for 3.375 discount points and cost. Puts the final APR at 8.236. So this is the real true conventional that we can actually offer here. So this is the best one we can offer there. And look how much of a difference that is, 8.236 APR from the portfolio option all the way up here at the top, 7.5. So as the conventional rates go crazy, these portfolio options are amazing. So definitely recommend anybody out there looking for conventional. Conventional's a little crazy. Look at the portfolios. Now, let's do our final demo here. For most investors, our non-QM options are going to be more realistic. So for the final demo, we will choose our expanded guidelines, also known as non-QM. And the first thing we must select is income. The most popular income type for investment properties for non-QM is going to be the DSCR option. That's because it doesn't require any income or employment info from the borrower. We simply use the estimated rents from the property to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITA of the mortgage, aka the property cash flows, that's a ratio of 1.0 higher. We even have options for under 1.0 where the property doesn't quite cash flow. For the demo, we always use 1.5, which is the highest value, so we can see all the options. And the final thing we must select is a prepayment penalty. We always use 3 years for the demo. That is the most common. We can choose 0, that will cost more and limit the amount of programs that pop up. And 5 years will save us some money in that case, but will again limit the amount of loan programs that pop up. We always use 3 years for the demo. So let's check out the DSCR options this morning. And cool, we got a couple that do still beat conventional, which is absolutely amazing just because conventional is crazy right now. So the first option here, 7.875 rate, 3.25 discount points in cost, the final APR at 8.017. So this is a great option. And again, it beats conventional by a little bit there, the true conventional options we could offer. Didn't quite beat the portfolio option, but I would say most investors, instead of doing full doc, would prefer a DSCR loan. A lot of flexibility. You can do 1, 2, 5, 10 loans at a time in order to refi multiple properties, purchase multiple properties. A ton of flexibility there with no income or employment needed. And if we scroll down here, we see that there's a bunch of different options. Some of these may allow bankruptcies, foreclosures, other credit events. Some of these at a little bit higher rates and costs may allow things like calculating income using short-term rental income. Some of these may allow to add features such as interest only, 40-year, or segue into our next topic here, ARMs, right? Adjustable rate mortgages are always basically a variation of most of these products. We don't do them live, but we're going to do a deep dive into these. ARMs are a little more complicated. Obviously, every ARM is different. It stands for adjustable rate mortgage. And adjustable rate mortgages are just obviously a little more complicated to do in the live demo. We have to explain what index we're using, what margins we're using, when the changes are, the maxes and the mins, all that kind of stuff. So because it's not a standard straightforward loan, we definitely want to take some time for Jose to unpack some examples here of some specifics. But just know that when we do the live show, any of those things you see live, typically we can select an ARM variation. And as the rates go crazy, like today, when we're at a 18-year high or whatever it is, when the rates are going a little crazy, the ARMs kind of become more of a popular topic. So I think it's a good time to talk about it. Recently, they haven't been as competitive. There hasn't really been a delta between a fixed rate loan and an ARM version that would uh, really make us say one is better than the other, right? ARMs are obviously going to have a little more risk. So unless they're a lot cheaper, a lot of times it's not necessarily recommended. But as markets change, and we're definitely in a changing market right now, the ARMs are definitely something to keep an eyeball out for. And in some cases, they do save our borrowers some money. And in some cases, they're the right tool for the job, right? So, not all cases. And it's definitely been for the last 2 or 3 years. They haven't really been as popular because they just haven't really had that delta difference between a fixed rate and an ARM to really justify the little bit of extra risk that comes with that. So, Jose, hopefully that's a good intro for you. But let's go ahead and look at your specific examples. I don't want to put any words in your mouth there because I know they're very specific.
All right. Good morning, everybody. Thank you for joining us. Now, ARMs definitely can be confusing, especially if you look at some of those teaser rates when you're looking at ARMs. Uh, when you are considering ARMs, one of the most important points to take into consideration is what is being used as the qualifying rate for the loan, right? Because if you're looking at that teaser rate and everything's looking good, and then all of a sudden you submit your file to underwriting, and then you realize that they're underwriting your loan at the fully indexed rate, and all of a sudden and maybe they may go fully indexed rate plus, just in case, to throw a little bit of cushion in there. Now all of a sudden your borrower may not qualify, right? And then you got to go back to your customer and explain, and now credibility has been lost. So if you are going to consider the ARM, then please understand everything that goes into qualifying the borrower, and also everything that goes into disclosing an ARM loan, right? You have to have all of those factors: first adjustment period, how much, maximum, initial, start rate, maximum rate it can be. There's different factors, the index value, the margin, a lot of things that have to be set in your file so that you can disclose it. And then we get to what we were discussing the other day in the training that we had on Wednesday, I believe. We're talking macroeconomic factors, Federal Reserve, open market committee meetings. What are they going to do with their treasury securities? Are they going to print more treasury securities and then buy them back? I mean, these are all things that affect the rates, as we're seeing what's going on today, right? Federal Reserve said, we're not really sure we're done tightening the noose on the economy. So now we get volatility. All of this will affect ARMs, especially if you go with the ones that look really attractive, those 6-month ARMs that basically after 6 months start adjusting every 6 months. Those can be pretty scary when you figure some of those are based on the SOFR rate, SOFR index, SOFR, which is currently at about 5.3%. And then you got to add the margin to that, which could be 2, 3, 4 points, depending on what that investor is adding as a margin. And then you have your fully indexed rate. So a lot of factors to consider. This is probably not the best environment for ARMs. We're seeing very little benefit between an ARM and a 30-year fixed rate product. At best, on a 5-year ARM, we're seeing like a 0.125% betterment, and in some cases, it's actually more expensive. So make sure that you fully analyze that. So, with all of that, giving you all some context, let's share some rates with you. Now, here we have a 6-month, and I was trying to.
Can you zoom in a tad? I think
Sure.
one more level.
Okay.
Yeah, better. Thank you.
Go. So, since we love our DSCR loans, right here we have. I have some DSCR examples here for you. we have a 6-month arm, as I was referring to. So you can see, obviously, these 6-month arms do look very attractive in the rates, right? 7.875, but we have some 30-year fixed rate options, not much higher than that at the same cost, but 7.875, and you can buy it down all the way to 6.625. Right. But again, you'd have to look at what your fully index rate is there, because I'm
That's
thinking
the very unique six arm, guys. Six months. Nobody else has that. That's a very unique one. So that one's special.
Yeah.
AKA that teaser rate's only for 6 months, right, Jose?
Yeah, correct. And then after 6 months, reality sinks in. So now here we have a little bit easier now to plan with this one, because it's a 5-year fixed, and then after 60 months, it converts to the same 6-month arm, right? So here you're looking at a little bit higher rate, but I mean, if I'm picking an arm, I'm probably looking at this one, unless the other one lets you qualify at that teaser rate. That's a different story. But here you're looking at 8.625 costing you half a point, and you can buy it down to 7.625. So again, this one lets you plan a little bit better, right? And now we have our 7-year fixed. So adding an additional layer of security here, right? So in this case, our rate goes up, I believe, by a quarter point there. Let's see. Yep, half a point here. It is 8.625 rate. And this one, half a point, is 8.875. So for an extra 2 years of fixed rate ability, you pay a quarter of a point higher. And now, showing you a bank statement option, right? Don't want to just focus only on DSCR. I want to give you a little bit other alt doc options here. In this scenario, bank statement, and now this is for the 6-month arm again, by the way. The pure 6-month arm, same rates basically as the other one. You actually have a little bit of a lender credit at 8%. Our par rate is 7.875, and you can buy that down to 6.625. And our last example, full doc. Now, I ran this to pull up a conforming, and I'm doing an investor example here, conforming rates as well as non-QM rates. And obviously, this is our portfolio program that we're highlighting lately. That's beaten the what agency business, because this is an agency type, because this does use automated underwriting, specifically, I believe, DU, to qualify the borrower, except, as Nick mentioned earlier in today's show, it does not have as vicious, I would call it, of loan level price adjustments as Fannie and Freddie are having. Fannie and Freddie are like, I think, around 3 points that they're building in, somewhere around there, 2.75 to 3-point loan level price adjustment that they're building into the cost of an investment home or loan or a second home loan. Whereas this option, which tracks them in the guidelines, except does not track them in the loan level price adjustment. So hence we get much more favorable rates here, 8.25, costing us a point. Buying it down all the way to 7.25, costing you 2.5. And let me put this a little bit into perspective, or in context for you all. The agency rates that were showing in my search that I did here were like the minute, and this is at 75% LTV also, by the way, we're showing like 4 points, right? Whereas this one is showing a quarter point as the lowest cost option. So we probably would be able to get an 80% option for this one. Probably costs like a half a point more. And that's it. So very good option here with our portfolio agency hybrid type product for full doc for investment on the arm. But again, you got to see what's your benefit here. This is a 5-year arm, not the 6-month arm. So this is a good alternative.
No questions on arms. Those were all SOFR arms, right? Everybody's
Yes.
SOFR now, right? So because Fannie and Freddie switched to SOFR, right now everybody's SOFR, right? Pretty much. So I believe those were all SOFR
Yes, they were.
arms. Pretty much hard to find anything not SOFR right now, right? So there was a little bit of a transition there for a couple of years where there was kind of hit or miss, but I believe everything we offer is SOFR. That probably you looked up, right, Jose?
Yeah, because that's secondary. That's what they have an appetite for. They're not going to deviate from the norm, which is the SOFR, and take chances that another index may have less favorable results for the ARM market. They're usually going to try to pick the arm that's going to most track the upward trend to make sure that they're covered. It's not like they're going to try to do the borrower a favor and say, hey, don't worry, we're going to go with the least aggressive index.
That's kind of what I wanted to talk about real quick too, though. So the only reason to do an arm in like an upward market would be to save a bunch of money, right? So they would be a teaser to say, hey, rates are going up. I'm going to get a teaser rate. Let me take this. And there has to be a delta, as I mentioned before. Now, the reason that arms are becoming a popular topic is because people are trying to find the peak of the market, correct? So can you explain a little bit more about, if we're at the peak, we don't need a delta, right? We're going to be hoping that our rate starts at 7 today, and in 6 months when it adjusts, it's going to be 6, right? They're trying to catch the down, right?
Well,
but can you explain the
there's
floors
a
and stuff
danger.
too?
But there's a danger to that. That all sounds good in theory, unless you actually look at the arm that you're getting and see what's the floor rate. Is the floor rate the margin? Is the floor rate the start rate? Because if the floor rate is the margin, then that's an easy one, right? But if the floor rate is your start rate or whatever they tell you it is, it doesn't matter what happens to the index, you may just still be stuck at that higher rate. So if that index plummets, which could happen when the Fed starts easing off on their monetary policy, that's going to drop pretty quickly, we hope, right? But then if you're stuck at I can pretty much tell you that these are going to be at a floor very close to the start rate, most likely, on that.
So again, people, like you said, it's in theory, right? You're thinking, oh, okay, it's going to adjust downward, right? The banks and the programs, they're protecting themselves. They don't want it to adjust downward. You want it to. They don't. They want it to only adjust upward, right? So all these products are going to be skewed. Be very careful, right? In theory, could be a good idea, but the floor rate is the floor rate. There's no change in that, right?
Right. And the other thing that you have to be aware of, this is the more dangerous part with the arms as well, is negative amortization because of payment caps, right? So if that index jumps more than your payment cap percentage allowable, let's say it's 2%, can't jump more than 2% in any given year on the payment. That doesn't mean on what they're charging you, right? So they're going to say, okay, it went up 2% or 3%. We're only going to raise it 2% because of your payment. So you're like, woof, dodged the bullet, right? No, you didn't, because now that other 1% that you're not paying is getting added to the loan, negative amortization. And due to the fact that this is an adjustable rate loan, your loan recasts continuously. You're paying based on what you owe, right? You're not paying based on a set amortization table. So in moments of rapidly rising rates and you got these payment caps, now you got negative amortization. Now you got, it's just going to mess you up. So I don't know. I mean, I would, unless there's a really good benefit to the arm, like I'm saying, they let you qualify on the teaser rate, and that's what lets your borrower qualify, and that's a real benefit there. Versus the opposite, that you submit to underwriting and now you realize they're underwriting you based on a fully indexed rate or something of the matter. And now what did you really what did the borrower really get into? So
Yeah, I'd say I don't think I've ever advised a client to take an ARM in my career, but I've only been here for 5 years or so, 4 years, so it's just been that market. But I'm sure you've advised a client to take an ARM in a previous market, right? There is times where it works, right? It's just not now.
There are some options out there in the where we do have some specialty lenders out there, like when we're dealing with foreign nationals, for example. We have some specialty lenders that we partner with that actually do offer like a 3, 5, and 7 arms that have pretty low rates, where you're looking
But that's going to have a big delta, right? You're going to
right,
save,
and that's the only products, that they offer. See, so for that customer, if that was their only option, all they're going to have is a 3, 5, or 7 year arm. They don't have 30-year fixed rates at these outlets. So yeah, there's few and far between where you may actually get some type of a benefit, but that's not going to be for DSCR. That's not going to be for bank statements or anything like that. That's going to be a full doc loan where you may be trying to do like a non-warrantable condo, or maybe doing a foreign national loan. That's basically it.
So with a grain of salt, right? So just understand, and they will become viable at some point. I just don't think it's quite at the moment.
All right, no questions, surprisingly. Let's go ahead and wrap it up then. 11 a.m. Eastern every weekday we do this show, so we'll be back Monday with a new topic. Thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. We'll see you Monday, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everybody. Have a very productive weekend.